is there is no such thing as a passive investor. There can't be a passive investor. And what we did was we introduced a type of investor who operates off of a very simple algorithm. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. And so as the asset value rises relative to the income potential for contribution, in other words, multiples expand, you eventually get to the point where the withdrawals exceed the contributions. And then it becomes a question of, does it correct quickly or does it correct slowly? We literally just lived through this, right? We went from 0 to 5, and we went from 0 to 5 on the 30-year, taking 30 years from, 55% of the index to 36% of the index. That's really what just happened. And so now that incremental dollar going in, instead of buying 55 cents of the 30-year, is buying 36 cents of the 30-year. That's not good.
All right, Mike Green, welcome back to Excess Returns. I'm Dave Noddick. We're going to dig into the active passive debate, something that you and I have talked about many times over the years, perhaps have not actually recorded a podcast on. I don't think we vigorously disagree on much, but could you maybe just catch us up to date? We had some initial academic work a number of years ago from Gabe and Koizen talking about inelasticity in markets. That is, that when you put $1 in, more than $1 of reaction happens. There's been a lot of work since then. You've been involved in some of it and critiquing some other of it. What's the state of the art on our understanding of passive flows and how they're impacting markets?
Yeah. So first of all, thank you very much. And it is shocking that you and I talk all the time in an offline world. And there's even been podcasts in which you've been on reviewing my other podcast appearances. But I don't think we've actually been on a podcast together. So this is a first, and I'm excited to do it. You're a good friend, and the preparatory materials you sent me were awesome, as we discussed. So I began doing work in this in 2016. The key thing for me that came out was a paper written by Lasse Pedersen. That was the same time, by the way, that Inigo Fraser-Jenkins came out with his Passive is Worse Than Marxism. While I think the idea of the voting component or the allocation of capital component is critical, it's somewhat secondary to what I actually think is the much more important issue, which is the functioning in markets. And so in 2016, Lasse Pedersen introduced what I think is the most important paper in terms of setting the new trajectory, which was a paper called Sharpening the Arithmetic of Active Management. Went back and challenged the original Bill Sharpe paper from 1991 called The Arithmetic of Active Management, in which it was laid out the framework that really powered the growth of passive from that point, which is the idea that active managers and passive managers, by definition, in aggregate, own the same portfolios. The only difference between the active managers and the passive managers is going to be the fees that are charged. Therefore, in aggregate, passive will outperform active over time. This created the theoretical framework that has slowly allowed passive to grow from 2% of the market to about 50% of the market by a total market capitalization, and has done so under a framework that it's a smart thing to do, right? Now, Lasse in 2016 identified that could become an untrue condition under certain frameworks. And he, was one of the first people to very, very carefully read Sharpe's paper and challenge the underlying definition of what a passive investor is. And so I share this slide all the time. If it's okay with you, I'm going to share it in our discussion here. The really critical point is what is the definition of passive management in that context? So this is going back to Bill Sharpe's The Arithmetic of Active Management in 1991. What is passive investing? The definition of a passive investor is someone who always holds every security from the market. And an active investor is one who's not passive. Now, the problem with that is, how does a passive investor get into the market, or how do they get out? And the answer, unfortunately, is magic, right? Literally, there's a footnote that hypothesizes that any transactions from passive investors happen in the liminal hours in which the markets aren't open and, or after all of our analysis is done, right? That's just silly in terms of its construction.
And always at market average prices. Yeah.
Right. And always the market average prices, et cetera, right? So Lasse Pedersen's insight was very straightforward, which is occasionally the indexes themselves rebalance. That means the portfolio that is held by the passive investor currently does not match the portfolio that they have to hold in the next period. Therefore, they're forced to transact during market hours. This is index arbitrage, index inclusion. It's become the largest business for hedge funds in any single area, dominated by the multi-strats like Millennium, Point 72, et cetera, Citadel. And so there's a very prescient insight that came from Lasse Pedersen, that when the index itself changes, the passive investors are forced to change. My contribution to this analysis was slightly different, but unfortunately, I think it's actually a much bigger deal, which is when the portfolio of the index investor changes by virtue of their end investor action. In other words, you make a contribution or you make a withdrawal. What you've actually done is change the composition of the portfolio, and it now needs to be traded again, right? And the minute you recognize that, you recognize there is no such thing as a passive investor. There can't be a passive investor. And so all of Lasse's work and my work and most of the academic work that has now followed basically is focused on this idea of what happens when you add cash or take cash away in the market or within a portfolio.
To clarify something, this looking at sort of endogenous flows is a significant component of how pricing mechanisms work is a relatively new way of looking at markets, right? I mean, we've now got sort of demand asset pricing models that are sort of competing with more traditional CAPM versions of how you think about asset pricing that are remarkably explanatory for what we see in markets. So that move towards focus on supply and demand for security for portfolio assets has been, at least in my idiot head, one of the biggest shifts I've seen in academic finance in the last, say, 15, 20 years has been this movement towards understanding that flow really matters. Is that accurate, or was there a long body of research just not in equities?
So the quick answer is no. It is a brand new field of finance and a brand new avenue to tackle a field of finance. And it really was not introduced until I believe the first papers around these flow characteristics were focused on the large demographic components. So this would be, I think, guys like Paterba or others who focused on the implications on the demographic front. I'm blanking on his name right now. It starts with a G. Oh God, it'll come to me in a second. I'll shout it out Tourette style. Prior to Gabe, there was another G who focused very much on this idea of overlapping generations. I want to say it's Giannakopoulos.
Right.
Giannakopoulos. Yeah, it's a Greek name. So there was a recognition that the flows that were coming in differential components associated with an aging population or demographics could impact this. And the San Francisco Fed released a paper in 2011 focused on this, et cetera. All of those predicted that we would actually see, as the baby boomers hit retirement, we would see price valuations fall, right? Because there would be more net selling than there would be buying. And so there's this confusing and largely dismissal of that in the 2012 to give or take 2016 time period, where markets didn't do what people expected. Valuations began to expand in defiance of the demographic framework. And the question became why, right? And when you talk about the diagnostics that are now being applied, right? What's called the demand side analysis. It's a super complex problem, right? Like if you just mechanically think about it, right? There's 3,500 public stocks in the United States. My decision to buy one of the 3,500 is contingent on the behavior of all the other 3,499, right? If it is the worst performing stock, if it becomes the cheapest stock, then that becomes very interesting to me. But what if it just slightly cheapens while everything else cheapens? Does that affect my demand curve as it relates to that individual security? And so you can figure out very quickly that this is a dimensional problem that is really, really hard to solve. And it's one of the reasons why we adopted the efficient market hypothesis, not because we thought it was true in its totality. Cliff Asness will regularly talk about Eugene Fama challenging it and saying it's not totally true. But it was like a map of the territory. It was useful, and it allowed us to build models that allowed us to apply a degree of rationality to risk-reward trade-offs. That's what the CAPM framework was really about. Okay, but it was purely theoretical, and it hypothesized the idea that given the information, that you were able to derive the information, and that each individual basically had one vote that the wisdom of the crowds would guide us to something that approximated an efficient market. And that by and large accurately described the market that we lived in through most of our lives. Now, two things happened. One is, just like Newtonian physics are perfectly adequate for circumnavigating the globe, but they are completely inappropriate for semiconductor design. Right? Once you move from a small portion of the market that is investing as if this hypothesized framework, the efficient market hypothesis, was right, to the majority of market behaving in this way, it's very much like that difference between Newtonian physics, which is a very close approximation, and quantum physics, which operates at an entirely different scale.
Well,
And so
I would argue it's significantly worse than that, because the efficient market hypothesis is foundationally removes the human being from the decision, right? It is a mechanical explanation of preference and behavior. What I think we have discovered in the intervening years, as we've developed now things like the inelastic market hypothesis, is that human behavior has all of these components that are not necessarily easily described by these sort of mathematical preferences and patterns of returns. Like, for instance, the tax treatment advantages of investing a certain way versus another way, the free money from 401k matches, all of these very human reaction functions that are very, very difficult to model, which is why I think, to me as an investor, focusing on flows seems much more intuitive, because at least there I have some very explain it like I'm five foundations to understand, which is that if I want something and Mike doesn't want to sell it to me, I'm going to raise my demand until you eventually capitulate and say, fine, if you want to pay me $1 billion for my bicycle, I will sell you my bicycle. That feels much more human and intuitive in terms of how we actually get to pricing behavior. And it seems to me that the intervening work has really done a good job of identifying that.
It's really advanced the field to an extraordinary degree, but with very uncomfortable conclusions. Right. Imagine, we used to joke about this. We used to experience this on a fairly regular basis, where we'd read the news story about somebody following their GPS so closely that they drove right off the road into a swamp, right? Because it wasn't there on the map. Right now, that's very similar to how I would describe this phenomenon. And it's really interesting, when you talk about things operating at scale, this reintroduces the global financial crisis, right? Like, the insight on RMBS is 100% correct. Any individual mortgage behaves in a somewhat unpredictable fashion. I can lose my job, be forced to sell my house and relocate. That is largely unpredictable. But what is predictable is the behavior of thousands of mortgages or tens of thousands of mortgages, because that idiosyncratic risk is reduced. The problem in the GFC was the assumption about how those mortgages would behave. So we assumed, as we increasingly were assigning mortgages risk characteristic associated with the aggregate behavior, and therefore we were much more willing to take risks than we otherwise might have in areas like subprime, et cetera, which we had a historical representation that said, guess what? These things are fine, right? They don't really have an impact.
Right.
But once we got to scale, and actually, ironically, the system began manufacturing mortgages to fill demand for investment product as compared to mortgages to fill demand for housing, right? We created the global financial crisis. This is the same underlying phenomenon. We have effectively driven to the end of the road, and the road, we're supposed to stop, but the GPS is saying, well, statistically, a road that is continued is going to continue, right? And so, that's where we are at this point. And I agree with you. The new systems are doing a much better job of explaining behavior. The old system basically involved, I collect a whole bunch of information, and if my information is deviant enough from what the overall market position is, then I have an incentive to transact, and that transaction will, in a very, very minor way, slowly start bringing the market back towards fair value.
Right. So the state we're in now, I would describe as, and I'm going to fast forward a bunch of the mechanics here. People can go get all the links at the bottom of the episode. But the model that we have now is, the way to think about it is that for any given dollar showing up in the market in passive, so you can think of that as just, retirement, that allocation of another $1,000 going into the S&P 500, or the portion that goes through their target date fund and ends up in the S&P 500, that dollar turns into an increase in market cap in that index of stocks of, depending on whose math you want to use, somewhere between 5 and 20, right? Meaning there is a multiplier effect because of the inelasticity of demand there, which means that for every dollar that comes in, there isn't a dollar waiting in the wings at this exact price to immediately fill that demand. It has to move a certain amount before the other market participants are going to vomit those shares back out in so that the passive investor can get access to that flow. Now, there's been a lot of discussion about what's the actual multiplier, right? Is it 5, which was the Bay and Coizen sort of initial take? There's now been some refinement to that, which could be anywhere from 11 to 20 to 25. I mean, very large multiples. And obviously, this is going to be idiosyncratically different depending on how you measure it. It's different if you're looking at $1 in the S&P 500 versus $1 into the Mag 7 versus $1 into the Russell, right?
Yep.
They're all going to have their own unique components, but they all have this general quality of more money comes in and it has this accelerated effect on actual prices. The reason that that's uncomfortable for investors is it implies that we're living in this sort of volatility up, volatility down world. How do we mesh that observation? And it's not a theory, that's just an observation, right? We can look at stock charts and everybody can see that. How do we mesh that with what I would argue is the equally obvious efficiencies that have been created through things like ETFs and passive investing vehicles? I mean, it's inarguable that my access to beta as an investor has collapsed in price in my lifetime from multiple percentages to single digit basis points. So, and for the most part, you look, most measures of market efficiency are way, way, way up versus, the 80s, the 90s, the early 2000s. How do we square that circle? How do we have both a highly efficient, highly effective, high volume market, but one that is subject to what appears to be these distortions?
Well, I think that there's a couple of things that are really interesting there, right? So among other things, like think about what you just described. You have been given low cost access to beta. I'm sorry, what is beta?
The market return, right?
What is the market? Is the market the S&P 500? Is the market the total market? Is the market inclusive of private stocks? Is the market inclusive of small companies in your local community?
I would argue that in all of those cases, my access has gotten cheaper and more efficient.
I would actually
take every one of your definitions, and I think the answer is yes.
Yeah, so I would actually argue that is very much untrue. And so what has actually happened is we have given a preferential access at low cost to the existing publicly traded equities. The existing, that's important, right? It's one of the reasons why we're getting a paucity of IPOs, because by definition, a new IPO is not in the index. And it requires active managers to subscribe and support that through the process of a traditional IPO, right? And those active managers are losing the ability to do so. And so, one is you're gaining access to beta defined as existing publicly traded equities in a certain proportion, right? The second issue is when you describe that as efficient, again, I've gained efficiency in a particular type of investment, right? That disadvantages small business. It disadvantages local communities. It disadvantages alternative forms of investment that I might have made historically, like starting my own business, because I've now provided a differentially low cost of capital to their competitors, right? So all of these factors are actually now playing through. What you're describing as efficiency is largely an academic demonstration of how much do the prices actually react to information. Perversely, the larger that multiplier gets, the more efficient the market becomes in a macro framework, which is what the evidence actually suggests, right? So if prices move, if a company gets a lower and lower effective float because it is more and more held by passive, and therefore when information comes out like an earnings report, and that earnings report engenders a giant move because now the stock is basically low float in its characteristic, and the active managers who would trade out that information are trading in a smaller pond, and therefore causing a larger disturbance, perversely, that's called more efficient.
Well, it is in some ways, right? I mean, I guess this comes
Yeah,
down to
I
a
agree.
definition.
In the academic sense, it is more efficient if Meta falls 50% on an earnings report and then reacts exactly like the market from then on, right? That ends what's called post-earnings announcement drift. That is viewed as a measure of efficiency. Is it at all efficient that Meta falls 50% on one earnings report and then rises 50% on the next earnings report? No, that's actually not efficient from any reasonable assessment of it, but it is
From
very
an
efficiently
allocation of
accurate.
value and capital perspective, sure, I understand that. Like, you wouldn't want to build an
But
entire system where you were
but
making.
Dave, that's actually part of the point, right? You use your GPS not because you're trying to get an accurate representation of the map of GPS. Yes, it gives you lower cost access to maps. You use GPS because it facilitates your transition from one destination to another,
Well,
right?
but by that definition, target date funds have been the best invention in market history because they have been an enormous vehicle for helping people transition from one set of investments to another.
Again, a particular set of investments, right? And we have created all sorts of incentives around it. The issue is it differentially biasing behavior in our economy towards certain outputs? And I think the answer to that is unequivocally yes.
Sure. Yes. I don't think we're disagreeing on that, right?
Okay.
The impact of this effect, right? So first of all, there's does this effect exist? You and I both think it does. I think the majority of the academic research now, the preponderance at least, suggests that yes, these effects are very real.
And we're seeing more and more defections from people who have historically defended it.
Like a Larry Swedroe or somebody like that. Yeah. And I think, I think there's real value in people who are very loath to change their long-held and well-researched opinions. And so I think they're very valuable to see how those folks react to new information. And my observation has been a lot of those folks who have been very resistant to this line of inquiry, or to at least to the conclusions of this line of inquiry, are starting to recognize, okay, these effects do seem to be here in the market. Now, if we just take all that for granted and we can play through what that implies, it implies more dominance at the top of the cap table. It implies lower IPOs, right? I mean, it implies, mega corporations, and there's been good research around that. The rise of the mega corp as a result of this. There's been a great recent paper on that.
Yep.
So let's just accept all of those as truisms. There's then two avenues that I think for our audience are helpful to think about. One is what would it take for this to no longer be true, either because of market reaction, investor behavior changes, policy distinctions, changing in market structure. So I think those are interesting to understand, because then we can observe as those things happen, we should expect different market reactions. And then the flip side of that is, assuming nothing changes and the market just continues along its merry way, what does this imply for our portfolios? And what should we do about it? Because the initial conclusion would be, I guess, just keep investing at the top of the cap table, because those are the ones that are going to go up most. And most of us as individual investors care much more about whether our personal bag is secure than whether or not capitalism is working. So in those two angles, the pick one, either the policy response and what should we look at to know it has changed, or the investor part. I want to hit both. Which one do you want to hit first?
Let's hit the investor part, because that's actually the easier one, right? I mean, the quick answer is you're 100% correct, right? The answer is you as an individual should be working to exploit this effect as much as you possibly can to maximize your individual outcomes, right? And so that means that it is almost impossible to beat the S&P 500 or an even more large cap passive skewed index that really benefits, right? A Mag 7 type framework where that multiplier is even higher. And just to give some perspective on that, we can actually walk through how those multipliers are derived, what they work out to, et cetera. My work suggests that those aggregate numbers that we're talking about are correct. But even if we look within Haddad's paper in 2022, which is really the one that isolates this intra-market dynamic of the multiplier effects, and then was built on by Zhang in the paper that you were referring to about passive dominance. Haddad will acknowledge that the data that he presents is intentionally actually underplayed because the actual output is so offensive to efficient market models that he was very worried that he would basically be slapped.
Correct.
Right. And even within his data sets, as the data is presented, I shared with you one of his co-authors pieces, in which it's broken down on the basis of deciles, or, the 90th percentile or the 25th percentile type framework. When we talk about the Mag 7, we're talking about the 0.1 percentile, right? We're talking about 7 stocks out of 3,500. So technically 0.2, in terms of the 0.02% on by number, right? And for those, the multipliers are now crossing into triple digits, right?
Right.
So like it's
But
becoming
in
a
that,
huge issue.
but in that world also, I think so yes, I understand that's what came out of the data. Those stocks also strike me as the ones where I could probably poke the most holes in terms of valuation methodologies, because we have seen sort of, at least at a gross level, if you look at the most actively held stocks, they're also the Mag 7, right? So there is this sort of oxymoron where if you look at stocks 20 through 500, they're massively passively held. If you look at the top 20 stocks, it actually falls off because those are also the names that individual investors and active managers are day trading like mad. So I'm wary of wading too deeply in there, because that strikes me as a place that's rife for more sophisticated analysis. So I understand why they might not want to say the multiplier effect on NVIDIA is 50, right? Because that seems insane, right? If people put $100 into it, they don't expect it to go up 5,000. And I think that there's some room for that math to be wiggled and to be wrong. But back to the point for the individual investor, the implication is the top of the food chain keeps growing, but it also is that when something reverses, and when something reverses in this case is just more aggregate selling shows up for whatever reasons, it can just be sentiment, you would expect the same kind of reaction on the downside. That often gets put out in the press as, well, that's why you should hedge everything. And that's always the wrong answer too, because it's never cost efficient to do that. You've talked in the past about things like doing, big out of the money straddles to try to take advantage of big vol moves without having to spend all that money to hedge the inside. Does any of that actually work? Do you feel like we're in a market where a sophisticated option strategy can actually outperform here?
I think it's very, very hard because of the path dependency and options. So the technically right approach is that long straddle. It's simplified. We do have a portfolio that is built in that way. It effectively buys calls and to a lesser extent buys puts. That has delivered modest outperformance, although not as smoothly as we would like it to. And so the answer is effectively, like, if you're going to capture the upside, a call option will work. If you're trying to capture the downside, a put option tends to be a little bit less effective because of the underlying drift, right? And so, you've seen these slides. I'll just share them very quickly so people can see, the actual kind of math behind what's occurring here. I just want to help people understand this, so that we can make sure we're all talking from the same playbook. So, part of the demand side analysis, I did it in my own way back in 2016 in a far less sophisticated manner than Gabe and Koyjin, or in particular Ralph Koyjin and his partner, Hugo, I'm blanking his first name, have built in terms of the demand side analysis, right? But I asked a very simple question. I simply tried to establish what are marginal propensity curves, marginal propensity to buy and marginal propensity to sell. So I went out and I asked portfolio managers a very simple question. I said, you're a portfolio manager, you have 5% cash in your portfolio, so cash is not a constraint in either direction, right? You receive an inflow or an outflow. What is your propensity to buy or sell based on that inflow or outflow given valuation? And the totally unsurprising outcomes is that your marginal propensity to buy falls as valuations rise. Your marginal propensity to sell rises as valuation rises. That makes perfect sense in the context of a discounted cash flow type analysis where a higher price, all else being equal, represents lower return going forward, right? That should be totally unsurprising. What was really surprising coming out of it, though, is the intersection of these two curves at almost exactly 50-50. And remember, this is just a survey of 450 investors, right? but they intersected almost exactly 50-50 at exactly the market's historical valuation average. And the reason why that's so important is if I then build an agent-based model and I give them the responses from these surveys, and I then somewhat randomly give them cash and take cash away, the market behaves in a mean reverting framework, right? As prices, valuations rise, people become more willing to sell, less willing to buy. As valuations fall, they become more willing to buy, less willing to sell. The reality is, as prices fall and valuations fall, people become less willing to give them money because they think that stocks are suddenly a terrible asset to invest in. We see this over time. And so this tends to get more extended because it's not truly random in the acquisition or distribution of cash. But at least we now kind of understand what caused the mean reverting feature of the market. It's that the participants themselves discounted and behaved in a mean reverting way. And if we go back to the mid 1990s, about 80% of investors acted in this way. This is what drove the marginal transaction. Today, only about 10% of investors are being driven, or investment decisions are being driven into this framework. And so the propensity for mean reversion has been dramatically reduced. Instead, what we did was we introduced a type of investor who operates off of a very simple algorithm. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. In other words, 100% marginal propensity to buy or sell, regardless of valuation. And so as those investors gain share, the market moves from mean reversion to mean expansion. Okay. And this unfortunately matches exactly what we see in the market. The largest stocks become ridiculously overvalued, while the median stock is just becoming overvalued. Right now, because of capital structure components, there's actually some perverse consequences of this as well. These companies tend to have leverage. And so them being overvalued lowers their cost of capital in the debt markets, because the debt markets treat the equity as collateral, right? That says, hey, we don't really know what the right valuation of this thing is, but we're going to rely on the equity market, right?
But that just leads to the sort of runaway oligarchy scenario, which seems like from a political and policy perspective, seems like what's going on, obviously. Yeah. So that certainly has explanatory power there. But from the investor's perspective, the putting risk aside answer is, well, heck, just stay long. The thinking about risk perspective is, well, when this train stops, that looks like a scary thing. What would it actually take for the train to stop? Given, let's put policy changes aside, right? We could get rid of the 401k market. All sorts of crazy things could happen there. But is there a world that you can see in the 5 to 10 year time horizon where the marginal investor is so disenamored of the market that the propensity to sell overwhelms the structural flows we see from the retirement markets, from just sort of consistent allocations, from everybody around the world getting their slug of American exceptionalism? Like, that is not going to go away completely. So something would have to overwhelm it on the sell side. We sent the market down 9% over 3 days in April. Nobody seemed to care. It came back a week and a half later. Do we actually have?
Let's be clear. It came back in 1 day. There's a 10.5% gain in the S&P in a single day, right?
So why should an investor be concerned at all? I mean, is this not game so entirely rigged that there's really no reason to think of the music would stop?
So the quick answer is the music inevitably stops for the same reason the trees can't grow to the sky, right? Eventually, the thing to remember is that contributions are always going to be a function of income or borrowing capacity. Withdrawals are always going to be a function of asset levels. And so as the asset value rises relative to the income potential for contribution, in other words, multiples expand, you eventually get to the point where the withdrawals exceed the contributions. And then it becomes a question of, does it correct quickly or does it correct slowly? And the math behind, unfortunately, what passive suggests is that it would be a very quick, very sharp, and nearly continuous correction that is heavily influenced by where you start in the process. So I don't share this slide all that often, but I will for this podcast. I want to be very, very clear. This is a theoretical model of what ends up happening.
Do not
right?
blame Mike.
Do not play Mike at home, right? But, this is effectively what the model plays out to look like, which is very much like what I just showed in that chart. We had higher and higher and higher. If at any point the passive flows turn negative, and that is simply a function of more and more passive holders getting into that baby boomer or retirement stage, at which they are now actually holding assets that need to be sold in a passive framework, then the valuations retreat sharp.
Let me just challenge you on that fundamental premise, because this is one of the biggest complaints I've had about a lot of the target date fund research. You pick the number, 30 trillion roughly captured by the baby boomer generation, being handed down to millennials. I've been hearing this for 15 years. We know the demographics. The problem with this analysis, that everyone that I've read, is that either they're making the assumption that Mr. Wealthy Retiree has stuck in their passive equity portfolio until the day they die on age 80. And then all of a sudden, all of that has to be sold, which is ridiculous because we know that that's not how people at the age of 80 are invested. Or as they have aged from, say, 60 to their 80 deathbed, they have been consistently selling their equity and buying bonds, which is, we know fundamentally what's happening because that's target date funds. And we are now living in the current window where the first target date funds I was selling in the 90s are all coming due, right?
Yep.
We were selling 2020s back in the day. So we know that that is what has actually happened. We also know that when we're talking about investable wealth, most of these boomers are not sitting here on a portfolio that is barely covering their income needs. The bulk of the actual wealth is in people who have vastly more invested than they need to survive the rest of their lives. So when they get to end of life, one of two things has to be true. Either they're handing a bunch of effectively cash to millennials who we know are going to do two things with it: buy equities and buy houses, because that's what they do. Or they're dying and they have a bunch of equity, and you now have to make some strange assumption that their heirs are going to sell all of these now free from tax basis problems equities and buy something that is not indexed, that is somehow either just buying a house or buying or selling it all in cash. Those are both counter to all the evidence we have about what's actually happening. So why do we believe that there would be this wall of baby boomers selling equities when everything suggests the opposite's happening?
Well, there's two separate components to that, right? So first of all, when you talk about target date funds, target date funds really aren't used by those who are wealthy enough to meet the description that you described. The second is that target date funds are actually a relatively new category. So as you point out, you started selling them in the 1990s. The life cycle funds were first introduced in the 1990s. The first retirees that are hitting those are in that 2020 plus area, right? And we actually see this. There has been perversely a continuous bid for most bond structures. In fact, passive allocations to bonds is faster growing than passive allocations to equities at this point, right? So, one is, I agree with you that if your argument is eventually we will end up with wealth so concentrated that it'll all be held effectively in the hands of those who don't really need the wealth and don't need to spend it, then sure, we can sustain very high valuations, right? And that is a potential outcome. I'm not sure that's the outcome any of us had in mind when we started saving for 401k and 401ks as a retirement system for the broader American public. The second thing is remember that much of the wealth that you're describing in that way is actually not held in publicly traded equities. A large portion of that wealth that's held by the 1% is held in their private businesses or the real estate that they own, et cetera, right? So there is a mismatch when we talk about public equities and private equities. Even look at Bill Gates's holdings, which have now been diversified into something that looks an awful lot like the S&P with a slight bias towards real estate, right? He doesn't show up as a sizable holder of anything.
Right. But the point, the chart that you put up here is about people selling public equities, right?
Yeah.
So this implies that passive owners of public equities have to all of a sudden either become active owners of public equities, or they're selling to replace public equities with cash, with bonds, with real estate, with consumption, with something.
Yep.
So
And again,
my question is, what is it we believe will be that? Because it's certainly not the 30 trillion millennial hand down, because if anything, I can make a very strong case that will increase public equity participation.
oh, again, I want to be actually very, very clear. One, if the baby boomers were to hand it off right now, right, they would probably skew slightly towards equities. Right. If that handoff happens in another 10 years, it's going to be less of a skew because the actual millennials themselves are now starting to hit the point at which the glide paths start to reduce their equity allocations. The second point, though, that I'm emphasizing is that that is in and of itself ignoring that a sizable fraction of the investment public that is 70 or 80 years old, they're actually not in target date funds. The penetration of target date funds amongst the 70 plus set is actually remarkably low. And perversely, the penetration of passive within that group is actually remarkably low relative to the overall average. And so, like, I'm actually agreeing with you. The part of what is happening is the baby boomers who were allocated to value managers, for example, or active managers, are firing those individuals and replacing them with S&P exposure because they're like, well, I might as well just go with the low cost component. Right?
So what causes this chart?
Yeah. What actually causes this chart is eventually you get to the point where any type of withdrawal overwhelms the income levels, right? And so that is just very straightforward math. Eventually you get to the point. Imagine instead of $30 trillion, it goes to $400 trillion, right? Now, am I going to spend any of that wealth? Well, I am going to spend some portion of it. And in the process, I will bid up the prices for all the goods and services, right, in a manner that you would expect that biases towards those retirees, right? And so what are we going to end up doing? We're going to end up allocating our economy to cater to old people. Gosh, that sounds an awful lot like what we have. And so, again, the point is there is nothing that you as an individual investor need to do, but as a regulator and as a government, official, you should be very much thinking about, is this actually what we're trying to accomplish?
Okay, great. Perfect transition. So we've covered, I think, the first, at least a very high level, what should investors do? There are these convex tails that are worth thinking about, extraordinarily difficult to get that timing and pricing correct. For most people, the answer is going to be ride this horse as far as it will take you. Yeah. So now let's put our pundits, policymakers, wonks, and idiots hats on and talk about, what should somebody do? You and I have talked for years now about potential policy responses, like getting rid of the tax advantages that are baked in the system all over the place for passive investing. In other words, versions of make active management great again by reducing some of its barriers to being successful. That's a set of conversations we could have. However, it seems pointless because this administration and the previous administration seem to be going very much in the opposite direction. The strongest example by far are the so-called Trump accounts, which I think fairly uniquely in investment management history, not only mandate specifically the S&P 500 or similar index, but also cap the potential fee at 10 basis points in the legislation, which I found shocking because not that I'm against passive, I've had my whole life in it, but I am a big believer in market competition. So the idea that we're going to mandate this fee and this target investment is wild and very much counter to, I think, anything you and I have ever talked about in terms of how we would fix things to avoid this. What's your thought there? And is there some counter? Does the move towards putting crypto in private markets more in the public hands change your opinion about that? How do you balance these out?
Yeah, no. So first of all, I actually think, interestingly enough, what you just highlighted is one of the reasons I ultimately do think that this administration may be the administration that takes action. And so part of what you're actually doing there is you're saying, we think that passive, low cost passive plays a role and we want to use it to advantage younger people. That, by the way, is actually something I completely agree with. Right. And I want to be very, very clear on this. Part of, it's regularly put out that Mike Green hates passive investing. I don't hate passive investing. I just want to make sure that it is declared to be correctly what it is, which is a systematic algorithmic strategy that simply says, did you give me cash? If so, then buy, and buy in proportion to the public market caps, right? Float adjusted to be more accurate, right? That actually, interestingly enough, has value in the marketplace. When you initially introduce a new model for why you buy something, it's introducing heterogeneity into the investor universe, and perversely, it actually lowers valuations and lowers volatility and raises valuations. That's a net positive.
Okay. I get that, but you can make that argument about just the existence of 401ks.
I can make that existence.
Yeah.
Again, is it a good thing to encourage people to save for retirement? Absolutely.
Yeah.
Right? Is it a great thing to provide them with an incentive and to provide employers with an incentive to encourage people to save for retirement? Absolutely. These are wonderful, wonderful things. Within that, exactly as you're describing on the Trump administration's Trump accounts, is it a good idea to designate that you will only buy stocks in the companies that are owned by friends of Donald Trump? We would all look at that and be like, wow, that's a really terrible policy. Well, why is it good then to say it has to be the S&P 500? Because that's, while they may not all be friends of Donald Trump, and we can't directly point to the grift associated with that, what we can say is, wait a second, now the government is very firmly putting its thumb on the scale and providing differential capital costs for this selected group of companies, right? It's the antithesis.
But we do that. I mean, let's just be clear. We do that in every single piece of economic policy in this country. We pick winners and losers from oil to solar power. I mean, every single political decision has that component to it.
And I am absolutely in agreement with that. And therefore find the fact that we think that we aren't doing the same thing when we direct flows towards multinational corporations in passively traded indices in a liability protected and a tax advantaged manner, that we aren't changing the outcomes in our society in a very meaningful way.
Okay, but back to your point, you think this administration might do something about it. You haven't convinced me yet. Why do you think that?
Well, I will tell you exactly why. Because what we're actually talking about is making the largest companies more and more powerful, and therefore they become a threat from a policy standpoint to the actual regulators and government itself. And that is what I would argue is the primary tension that you're actually seeing at this point. You're seeing a system of democracy in which theoretically people are represented by having a single vote that empowers the individual. And at the same time, we're introducing an economic system and a capital markets assumption that biases us towards the largest and most powerful, effectively the nobility, having differential access.
But why do you think? I agree. I'm nodding along with everything you've just said there. Why in the world would you think that this administration is pushing against that when almost literally every single action we've seen has been in the opposite direction, towards more deregulation, towards skewing the playing field, more towards key large players, whether it's contracting, where we've given up all pretense of competitive bidding and everything is going to the largest player in the space, whether it's from SpaceX or Palantir or anybody else. Like, everything I see and read in the paper suggests that this administration is deepening the oligarchy, deepening the power of the most powerful corporations in the country at the expense of the individual investor, at the expense of the individual voter. So why do you think that there's going to be some sort of come to Jesus moment where all of a sudden we're going to become, capital socialists, where we say, no, we got to get we got all the barriers out here so all companies are on an even playing field?
Yeah, I actually am doing the opposite. Instead of a come to Jesus moment, it's a come to Satan moment, right? It is effectively saying, look, when these companies actually become large enough, or there are ways that you can influence these outcomes in public markets. And I would just point to Tesla, right? When Elon Musk was perceived as being tied in with the administration, everything was wonderful. He managed to alienate both parties in the past 6 months, right? So, like now all of a sudden Tesla is reporting terrible quarters and Elon Musk is hiding X inside, it's his Twitter takeover inside his new AI startup as compared to Tesla, right? There couldn't be a clearer signal that says, you could be $1 trillion company. And the reality is at the stroke of a pen, the government can wipe you out. So that's actually the point that I would emphasize is, as the administration is waking up to the power base that is created by the differential inflation of the equities of the largest companies, they are going to wake up to the threat that represents and act out against it. That's the point that I'm emphasizing. It's not a come to Jesus moment, it's a come to Satan moment.
But if you say act against it, the way I see this administration acting against anything is largely by fits of pique and executive orders, not
Oh,
actually changing market structures. So like the kinds of things we've talked about before that would change this are things like rewriting tax code and rewriting ERISA regulations. Do you actually think those are on the table in the next 5 years?
I think that the odds of that are higher under this administration than they were under the prior administration.
Huh. Interesting. I couldn't disagree more. I think Elizabeth
But
Warren was much more likely to do something about this than anybody existing in the Trump administration.
I think that Elizabeth Warren was far more likely to talk about it and far more likely to complain about it,
as opposed to get it
and
done.
far less far less capability to actually effectuate change.
Fair enough. Fair enough. As we've seen, toothless dogs can only bite so hard.
Correct.
Okay, that's
They
fair.
do slobber a lot, though, and foam with them.
I mean, this is the kind of thing I think we can gloriously disagree about because it's a giant unknown that neither of us have.
Yeah, absolutely.
Really.
I want to be very, very clear. I'm not projecting certainty in terms of my knowledge on this, but part of, and you know this, your experience, you've experienced this firsthand in our conversations offline. Like part of the challenge for me at this point is that I'm moving from trying to convince people that, look, this is happening, this is a big deal, to now actually trying to guide people to, well, what do we do about it?
What do we do about it?
Being involved in this. And there will be.
Let me ask you about the other inputs here, right? Because we've got tax code, we've got the retirement system, which I think in general is one of the bigger components of the flow issue. And now we've got, in both of those cases, crypto and private assets have entered the chat, right? And both of them are now being considered for broader inclusion in the retirement system. Both of them are now being considered for differential tax treatment. Certainly crypto is certainly on the page for being differential tax treatment. I would not be surprised to see something similar on how we deal with taxation and marketing of privates. So all of those things push in that direction. Does that change the math here? I mean, crypto, we know it's the greatest, it's the greatest lab we have for inelasticity because ain't nobody making no more Bitcoin.
Absolutely correct.
And private markets are sort of amorphous and difficult to measure for millions of reasons in terms of their actual impact on pricing and flows and capital. So how do you think about those two big movements, which I would say feel like where the gas pedal's being pushed by this administration in terms of security regulation?
Yeah, again, so part of not to go back and relitigate the conversation we just had, but everything you just. We're changing tax policy. We're changing X. We're changing Y, right? And why are we doing it? We're doing it in response to money, right? And so, the idea that it is going to be extended in a different direction, once we recognize that one of the ways of gaining more power is by reducing the power of your enemies or those who are not necessarily aligned with you, I think that's an easier ask than you do. But and you've also brought up Bitcoin, and I think Bitcoin is one of these fantastic tools. Like it's so fantastic from a theoretical standpoint. And I'll just share very quickly one slide on that I put this on Twitter all the time. So this is literally just looking at Bitcoin and trying to explain the movement in the price in Bitcoin over the last 30 days relative to the change in the Bitcoin that is held inside ETFs. And I mean, it's tough to explain to people how important a chart like this is, because what it's literally telling you is the only thing you need to know is what's happening to the change in Bitcoin held in funds, right?
Right.
All corporate treasury activity, everything else that's going on, et cetera, is largely meaningless in terms of its overall exposure. What is happening here is the exact same phenomenon that we're describing in equities, in which the price of Bitcoin is being driven higher by an increase in the quantity of Bitcoin that is held in funds. Is there utility to it? None that we've currently discovered, other than, hey, I'm rich. Right?
Well, and this chart isn't even really capturing, I would imagine, the recent effects of sort of the Bitcoin treasury movement, which is frankly just another way of Bitcoin held in funds. Certainly when we start looking at proxy companies that are just Bitcoin treasury companies.
Yeah, and to me, that's actually one of the interesting features that comes out of it is it doesn't attempt to capture those Bitcoin proxies, but perversely, those Bitcoin proxies in some ways could be sapping demand from Bitcoin itself, right? Instead of deciding to buy the Bitcoin ETF, I buy the current narrative
Mhm.
that owning MicroStrategy or some other, Bitcoin treasury fund is a way of getting a multiplier on it, right? It's just
Yeah.
like it's absurd, but there is an element of narratives to it, right? And so it is actually really interesting that despite the fact that you've seen this rise in treasury holdings of Bitcoin,
This is still
it
off
really
the
hasn't
notch.
shown up. Yeah.
Yeah.
I mean,
Yeah.
it's pretty incredible when you actually stop and think about that component. And so, again, this is just further evidence that this is really what's happening. And now the question becomes, well, what are the implications associated? What comes out of it? And again, the perverse aspects of it are some of it feels really good, right? Like if I own Microsoft and Microsoft goes to 100 times earnings, am I unhappy? Not if it's because the valuation rose and not because earnings fell, right? Like I mean, I'm happy, right? That's good. I've tripled the value of my Microsoft shares. That makes me feel good, right? Is it wealth in the sense that it can be spent? Well, not if I want to avoid the risk that prices ever come down. And so perversely, you end up, with a society that feels very much like, late 19th century England, where there's tons of wealth tied up in land ownership and very little in terms of actual industrial spending, right? That's going on everywhere else as you're hollowing out the empire. This is the experience that we're having in the United States. And so this is actually one of the really perverse aspects of this is like, it feels good to see valuations go up. We want to see the market higher, but that also then creates its own problems. And so we've forgotten this, but in 2003, there was a paper written by Jensen, who unfortunately has now passed away and who was a true lion in financial research. He wrote a paper called The Unanticipated Costs of Overvalued Equities, or the Agent-Based Costs of Overvalued Equity. And he basically points out that, look, everyone takes that seriously. If Microsoft is trading at 100 times earnings, we treat that as a signal about how wealth can be created in our society. And so if the answer to it is, hey, let's give all of our wealth to cash-rich companies that don't need it, right? Well, then guess what? You're going to get adverse outcomes with lower investment and everything else. And so again, what are the implications to this? Well, the implications are very straightforward. Markets go up. What are the secondary implications to it? Investments that should be made are not being made.
Right. Well, and that's a broader policy issue, right? Which is I think MicroStrategy is a fantastic case in point here, which is a, now enormously large company that has absorbed enormous amounts of capital that I would argue is really not doing anything productive in terms of capital allocation, as we would describe it in terms of capitalism, the way it's designed in the textbooks. And that is foundationally kind of the point of Inigo Fraser-Jenkins' point about it being worse than Marxism, right? In this case, every dollar going into MicroStrategy is a dollar that is not going to some guy who's building a better widget to do a thing that's actually going to add value to the economy long term. So in the Bitcoin example here, clearly these passive effects will impact Bitcoin even more than they will otherwise. If target date funds start throwing 1.5% into Bitcoin every monthly contribution, you're going to see these effects even more in Bitcoin than you do in the S&P 500. What about private markets? Because that's a really interesting question to me. If we saw a regime where, say, the average 401k plan could, alongside its target date funds, be offering a target date fund sleeve that's, 30% of its bond exposure is in private credit and 15% of its equity exposure is in private equity. How does that change the math? Because the signaling on pricing in private markets is so garbage. How could we even know?
I mean, the quick answer is that the immediate effect, of course, would be to inflate valuations further in private markets, right? You're introducing an additional buyer. It's no different than creating a Bitcoin ETF. There are a very few sellers of these, at least until the institutions are able to dump their holdings into the 401ks. Which, by the way, I would actually anticipate is the path that a lot of this ends up taking, right? That effectively this turns into a monetization framework for institutions like Harvard that are currently very cash poor because they pursue the David Swensen model of, hey, we never need cash. And then all of a sudden policy changes and they need cash, right? So I'm cautious on this one, but I want to actually say, to me, the really interesting thing that's happening with this threat of a move to private equity or to private assets is actually the loss of bid that creates for the public equities. And so perversely, like we actually saw this happen. I've demonstrated this before. I can show it on screen if you want. Like if we go back to August of 2015, you remember August of 2015 because of a very sharp correction that happened in the S&P 500 that was assigned to a Chinese devalue. So this is going back to August of 2015. On August 10th through August 12th, the Chinese devalued their currency by about 2% in an unexpected fashion, right? A week later, on the starting on the 18th and then through the 24th, U.S. equity markets corrected rapidly, right? Now, the question is, this ended on the 12th. This started on the 19th. Did the news like not come over the wires? Did they send it to us by drop ship? Was it a slow boat from China that brought the news over? Right? Like the actual reality is that equity markets were unaffected by that devaluation. What actually happened on August 24th, 2015 was that Vanguard rebalanced their target date funds. This is the last time they used to use a rolling 5-year period in which allocations remained fixed for 5 years. And then they would change the allocations in a step down framework. Right. And so on August 24th, 2015, Vanguard rebalanced target date funds, which then were about $1.5 to $2 trillion in assets. Today, they're about $4 trillion assets. Right. And with that rebalance, we literally walked in that morning, Johnson & Johnson priced at a penny, down from $85 a share. ETFs couldn't trade. The entire market was basically shut down for an hour as we tried to figure out the chaos of what was actually going on. And the reality is it was this type of rebalancing. Right now, what you're describing in private equity, imagine we take a scenario in which we reduce public equity exposure to reflect the private equity component, right?
Yeah.
That's a bigger change than we had here by a large magnitude.
Yeah. So the only mitigating factor would be that it probably wouldn't all happen in 2 days. It would happen over a long period of time and people would have ramp-ins, et cetera. But the net effect is going to be largely the same. And I think it's reasonable to question whether it's better to take a shot all at once and get the reaction function or just to have the slow, steady decline. I think reasonable people could disagree.
Yeah. And so part of it is a question of like, does that actually set off the process? Because think about what then happens. Each dollar that comes in, imagine it's currently a 50-50 bonds equities. We now suddenly switch it to it's 30 equities, 20 private equities. That means the next dollar in is buying less of those richly valued stocks as well. That pulls forward that point at which passive could turn negative in public markets. Right. So like, this is why I put out a chart or a tweet on this with, that sitting forward image as they decided to pass this, because this is actually going to meaningfully affect flows if they follow through with it. The other question that we just don't know yet is where is it going to take form? Right? Is that money going to be allocated to private equity? Is it going to be allocated to venture? Is it going to be allocated to private credit?
Well, and how will we value?
It's going to happen individually, right?
That to me, the much bigger question is how will we value those investments, both at the point of sale and ongoing, right?
Well, you know how we're going to value it. We're going to value it at whatever the private equity companies tell us they're valued.
No, but this is my point. We've seen this example at XOVR, the fund that owns a giant slug of SpaceX, which they have claimed has been worth $185 since December and has never moved in price. So yeah, maybe we end up with things like that, where now you've got a slug of SpaceX in your 401k, but at some point things do have to be revalued, right? 401ks have to be sold so people can take their minimum distributions at some point.
Well,
so there has to be a crisis.
Now you're telling me they're going to sell.
No,
you
but
can't have it like rates.
That's a reasonable point that, private equity would probably be the last thing sold out of a retiree's account on his
That's actually the objective, right? The objective is not to get it in the portfolios of 65-year-olds. The objective is to get it in the portfolios of 22-year-olds.
Right. And then,
and they are by definition holders, right?
Permanent capital.
They will hodl forever. Right. Or at least until we come to a decision that says, holy crap, this idea of investing in 401ks was a terrible idea. We'll never do this again. Right. Or we should be adding bonds. I actually put out a tweet the other day that shared allocators' responses in 2015. And in 2015, it was all about get out of equities and buy bonds. Equities were trading at
Right.
18 times, bonds were trading at 2%, right? We got a LDI match, right? We can see this ahead of us, right? Now, nobody wants to buy bonds. And in fact, the thing that frightens me more about the discussions of private equity and private credit is the idea is increasingly being floated as we replace the 60-40 portfolio with a 60-20-20, which is 60% equities, 20% private assets, and 20%, debt.
Yeah. No, and obviously those things would have huge impacts if they happened at scale. I guess I'm a bit skeptical that that this administration or even the next one or two will have enough chutzpah and mandates to actually pull that off. Like, I think we'll have conversations about it, but I think it's I think it's a bit of a fantasy to think that 5 years from now, the average 401k is going to be 5% in private anything. Like, I think this is going to be a much longer, slower burn. And I think to your point is the kind of thing that people who are currently 20 and 25 years old are going to be sold as they start hitting their peak earning years. And that's when this really starts becoming an issue.
And again, like part of the point is education, right? The simple reality is one of the problems with government action is that there is no real feedback mechanism. Once the change has been made, there's not much we can do about it.
And you can't really make the counterfactual because life is complicated. Yeah.
So, if Vanguard decides that they want to include private assets in target date funds, they're going in target date funds. In the same way that when BlackRock went from Larry Fink 2 years ago telling us that Bitcoin was, rat poison, to launching a very profitable ETF, to now wanting to drive adoption of that ETF by pushing it into model portfolios. Like, there's no fiduciary in that process.
Right. Well, as usual, you've cheered me up, Mike.
There you go. I'll make your hair fall out.
Yeah, that happened a long time ago. All right. Before we wrap up, anything that you're either working on or is on the brink of being published that you're excited about that's informing the debate?
Well, on the brink of being published, obviously, my book, which I'm working desperately on. And I have to be honest with you, writing a book is a labor of love for which I have none. But the stuff that I'm really working on right now, and it's one of the reasons why I actually think the administration is increasingly going to care, is actually the distortion that's happening in the fixed income space by virtue of passive. And that is a much bigger issue. And so I can share a few pictures on that I think are actually really important, that do influence what I'm advising people to do in their portfolios. And I want to be very, very clear that this advice is actually very anti to what at least the current mantra is of what's going on. And so maybe I'll take 2 seconds and try to share this. Okay. So for those who have followed this debate, one of the really important components of it has actually been a discussion that was introduced by David Einhorn on Barry Ritholtz's podcast, in which he introduced the idea that markets are broken. Right now, he credited me with the insights that brought him to that conclusion. But much more importantly, he actually addressed what was he doing about it. And it did help him a lot to understand this and change the behavior. So he effectively recognized that what was happening is his peers who would traditionally recognize value and buy stuff after he had identified it were being redeemed and reduced. And therefore he could no longer rely on them coming in after he had done the work and basically validating it, right? And so he began to focus on what he calls endogenous liquidity, effectively companies that would return his targeted return level, not through price appreciation or through others recognizing it, but simply through cash return, right? Now, the reason that becomes super interesting is if you actually think about the impact, if you think about the impact that or the behavior of equities in their totality, right? Equities effectively, and this is embedded in Black-Scholes, and it's one of the reasons we have different pricing for options and rates than we do versus bonds. This is what an equity payout structure looks like, right? You put $1,000 in. 30 years from now, maybe I have $150 and maybe I have $100,000, right? I don't know, but that cone of possibility expands over time. And this is literally what's embedded in all option pricing models. They're simply saying that volatility gives me exposure to a wider range of potential outcomes further off into the future. Okay. This is why I refer to equities as Ponzi assets, not because they're literally Charles Ponzi frauds, but because the return that you get is ultimately largely dependent on what somebody else is willing to pay for.
Right.
Okay. All right. Bonds, while they are also financial instruments, behave in a very different fashion. A high quality bond looks much more like an American football in flight, right? And this is the ugliest American football you'll ever see. It's the wrong color and the shapes are slightly off, etc. But the key point is that a bond returns a high quality bond is going to return a known quantity over its life, right? It's going to give you the coupon and it's going to give you the principal back. And that's
Just
going to be
the path. Right.
It's just the path, right? Now, there is a low interest rate path in which the bond rises in price, and there's a high interest rate path in which the bond falls in price. But the net result, if you hold it to maturity, is always the same, right? In other words, these are not Ponzi assets. These are assets that have tremendous endogenous liquidity.
Right. They're much more like David Einhorn's small cap problem.
Exactly. Right. Even more like David Einhorn. This is true endogenous liquidity. I can sell it, but I don't have to, and I will still get my cash back. Right. That means it is less subject to distortion over its entirety of its life than an equity is.
Sure.
And that has a very, very interesting impact, because a lot of what we're seeing in markets today, I would actually argue, is a byproduct. I'm looking for, there we go. Is a byproduct of what's happened in interest rates. So I'm going to flip over to this different screen. So this is the structure of the total bond market index, the Vanguard total bond market index, relative to the quantity of sovereign bonds, US government bonds that are out in notional value, right? And what becomes very, very clear is they are overweight the front end of the curve. They are underweight all the duration components. And the reason for this is very straightforward. These are market cap weighted indices. When the Fed raised interest rates, bonds that were issued in the give or take 2015 to 2022 time period fell in price dramatically, which means that they are just like value stocks or small stocks, receiving less bid per dollar contributed than the other bonds. Right? These bonds here are trading at give or take 60 cents on the dollar, right? That means that dollar in buys much less of them. This is, in my analysis, what has given rise to the bizarre performance that we're seeing, which is new issues are going off fine at auction. And then they become special. And effectively this giant treasury basis trade exists where I sell the treasury futures and I buy the off the runs, which embed in them an actual unique signature, a unique feature, positive convexity associated with the return profile if interest rates were to kick, right? So they become capital appreciation vehicles as compared to necessarily coupon vehicles. Again, a form of index arbitrage, one of the largest trades in the hedge fund space, just like index arbitrage in equities. But this one is perversely creating a narrative that exists in rates markets that the Fed has somehow or another lost control of the long end of the curve. Right. And so this is very actively influencing policy at this point.
Is this largely just about liquidity? I mean, if we're seeing this kind of discrepancy between new issues and off the run,
it's actually largely a function of the buying pressure that's coming from the passive vehicle, right? So this vehicle, give or take, is getting 101 cents for every dollar that gets contributed. This one's only getting 60 cents. Right. So what it's effectively doing is the impulse that comes in to buy these bonds is less than it was before. Perversely, that's the opposite. Again, I can flip back to my presentation because I used to show this in a slightly different framework, which is that much of what we actually saw in the huge sell-off was a byproduct of the opposite behavior. So if you actually look at what happened, I'm going to pull up to the bond market slides on this. So one of the great ironies is the question was always like, well, who's buying all the negative yielding bonds? What idiot would buy a negative yielding bond? Well, the answer was the passive vehicles.
right?
Because they were in the bond indices. And perversely, a negative yielding bond trades well above par. And so you're actually putting more buying power towards the largest names. This is why when the Fed cut rates on a fairly consistent basis over an extended period of time, effectively, the bond indices picked up momentum for duration components. It extended the duration fantastically of the bond indices and set us up for the losses in 22. So the area that I'm spending more and more of my research is actually on the bond side of the equation. The Bank of Canada actually just put out a paper in the last week identifying the impact of flows trading on Canadian bond yields. And they're beginning to wake up to this. Now, I will tell you that the conversations that I have with the US government around this are there's two ways you can treat this. You can manipulate it, right? Which would involve the Treasury buying back low priced bonds and reissuing at current coupons. And then when you cut rates, those bonds are actually going to rise in price. There'll be even more bid for them. You could reissue again, right? You can now start lengthening out your duration, right? And that would be the manipulative approach. The other approach would be for the government to say, no, we're actually going to mandate changes to how this is done. My bias is that we're going to see the former before we see the latter.
Yeah, it seems what would the latter even look like? Like how would they mandate changes into how people are doing this?
Well, among other things, the argument that you should be doing a passive bond index weighted on the basis of market capitalization is far less theoretically supported than the same thing in the equity space.
Oh, sure. No, sorry. That like academically, I understand that the ag is a dumb index. Yes, I get that.
It's a dumb index. But the more important point is people are being forced into that dumb index by policy at this point. Vanguard will be very straightforward. If you ask them outright, like, why would you possibly weight a bond index on the basis of market capitalization? They'll say it's very simple. It's easy to explain.
Yeah, no, I mean, I've been writing about bond indices for 25 years. They've always been stupid. And despite that, nobody ever manages to come up with something that's better that anybody actually wants to buy.
And that's the crux of my point is now you actually are you've grown to a scale that you're influencing outcomes at the political level that might actually effectuate change. It might not. Like,
it just seems like treasury operations is as a market guy, seems like buying the cheap stuff and reissuing seems like the smarter way to handle this. Because at least
I agree. That's why I think the bias is actually they're going to exploit it, right? And I would expect nothing less from Scott Bessent, who is an insanely smart markets guy, right? But it's also really hard to do that. Right? Because it feels very counterintuitive. Why would I buy back my low yielding stuff and issue new high yielding stuff? Right? That feels counterintuitive until you accept this mechanism. So like, I'll be very straightforward. This is a discussion that is ongoing right now.
Yeah, boy, the interaction between that and the inexorable pressure to get Fed rates down to zero so that real estate guys can have more of a field day. It seems like those two are going to interact in a non-positive way.
Oh, I actually think so this is actually exactly the point, right? The single best thing you can do if you want to actually make that happen.
Oh, is drop interest rates to zero. Yeah.
Well, no. Actually, first you reissue that paper at 4.5%, because if you then drop interest rates to zero, you're going to see those bonds rise dramatically in price and the bond index will shift. I'll show you one more example just to give you some idea of how profound this impact can be. Let me see if
I guess the question is, what do you think the policy objective is? Is the policy objective to extend the duration of the liability portfolio for the federal government? If that's the policy objective, then I get it.
I think it's, one, I agree with you. It does boil down to like, what do you actually think the policy is and what is the objective? And ascertaining that might very well be the most difficult thing to do with this administration. Right.
I definitely agree with.
Right. And so, you end up in this weird place where like, you're saying, well, one of the objectives, I'm saying, I totally agree with you. But if the objective is exactly as you described, to cause a boom in real estate, ironically, this is the best way to.
Interesting. All right. Well, I've taken it over.
I want to show you one more. This is one more downplay talking to Mike Green, right? So just to give you like some idea how extreme this can actually get, right? This is just a super simple model of 2-year and 30-year. Like, so let's just imagine that the market only exists of 2 years and 30 years, right? Look how radically I can change the construction of the index weights simply by changing rates.
Yeah, but this also implies that nobody changes any of the index rules, which, I think that it's not inconceivable to me that we see a restructure of some of those indexes the same way we have with things like how the NDX handles things, et cetera.
So I want to be very, very clear. This is not changing the construction of the index. This is just the
I get
market.
it.
You know,
But I'm just saying,
we literally just lived through this, right? We went from 0 to 5, and we went from 0 to 5 on the 30-year, taking 30 years from 60% of the index, or 55% of the index, to 36% of the index. That's really what just happened, right? And so now that incremental dollar going in, instead of buying 55 cents of the 30-year, is buying 36 cents of the 30-year. That's not good, right? And so
depending on your policy objective, right? I mean, that's
again, what we have actually created is a narrative. Oh my gosh, we're losing control of the long end. My work says there's absolutely no truth to that whatsoever, which then puts me into a very uncomfortable position to say all the fears about inflation and everything else are effectively just a narrative that helps explain why people don't want to buy bonds now. So if you buy into the David model of buy endogenous liquidity, identify areas that are being neglected by passive, candidly, duration is the area right now. And I want to be really clear, I could be completely wrong, right? It is entirely plausible that, under administrative fiat, we decide that we're going to give $1 billion to every American as a dividend for, electing, Republicans in 2026. Who knows what the right answer is, right? It doesn't actually matter, right? There are any number of ways that we can change it, but if those catastrophic views are correct, and I would just emphasize that I think those catastrophic views are heavily influenced by market behavior, right? We construct the narratives to explain price. And so, I'm in a very uncomfortable position where I have a narrative that explains price. It also says, if we continue doing it this way, we're going to have a lot of problems, right? And then we're going to make choices that are non-optimal in terms of capital allocation or investment. We're not going to have the society that we would like to have, right? And you could be 100% correct, by the way, that there's just not the appetite to change. And it just means it gets forced on us at a much later point. Well, it'll be
so we get squeezed into a world where corporate oligopoly actually runs everything, at which point policy doesn't matter because it's completely captured. So, and on that charming note, Mike, thank you so much for joining us again. I'm looking forward to seeing you in a couple of weeks. Maybe we'll record something up at Camp Code Talk. And this time I'm sure we'll have another clip show that I won't be the one that does the comment thing on, since I did this one.
There we go. Perfect.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.